Benchmark interest rates are near zero. The Fed made quite a bit of comments yesterday, and some people indicating that those comments are unhelpful in terms of what's happening in the stock market today. Let's get to Jim Grant quickly here to discuss what this could mean. Is Jim Grant, founder and editor of Grant's Interest Rate Observer. And I'll start, Jim, with what I was talking to Steve Leisman about earlier. Many people are saying that the Fed's appraisal of the economy it put a damper on sentiment today for the stock market. And I just asked a question about whether the Fed's overall action and the action of central bankers around the world, is there anyone worried about a day of reckoning for that at some point? And I think maybe you would be a person that thinks maybe this will be difficult to unwind at some point in the future.
Yes, it will be difficult to unwind. We have been winding for years and years. With every successive moment of crisis or difficulty, the central banks weigh in with lower rates, bigger balance sheets, and more intervention of all kinds. So what we see now is it's certainly unique, but it is if that's not a contradiction in terms, it's not unprecedented. There are precedents going back at least 25 years and arguably much longer. And, the chairman talks about the smooth functioning of markets, but the markets are not meant necessarily to be smooth. They are meant to discount future cash flows and to express the best guess of the collective group of investors as to the risk of default and impairment of credit. And what the central banks have done is to deaden those sensors. Junk bond spreads are back to were yesterday slightly back to below average for the past 10 or 20 years, I think, according to Marty Fritzen, which is astonishing given the state of things in the real world. So I would say that central banks have been instrumental in making markets less perceptive and to making them tell us less in the moment about how things really are.
I guess, Jim, in a real simple way to ask it is, when do you think either the stock market or the bond market will start to view the Fed and central bankers around the world as not part of the solution to all of our problems, but maybe adding to the problem and being part of the problem instead of the solution? We're not there yet, I don't think. Do you think we're really hearing accolades and praise for how the Fed has handled this? Do you think there comes a time where we look back, and you can even throw fiscal moves in on this too, as the debt soars, the national debt? Does there come a time, because we haven't seen a weak dollar necessarily, or a lot of inflation, or any of the things that hawks worry about, we haven't seen? Is that time coming?
I think it is coming. The muscle memory in the market is one of Fed dominance and helpfulness and competence. I mean, interest rates have been falling for, I guess in the fall, it will be 39 years. The Fed did not see the last crisis coming, but emerged from that trial with greater powers and greater prestige. So no, the market has not chosen yet to discount the Fed's abilities or judgment or capacities. But I think the moment of truth, we'll see it in a number of ways, or possible ways. One is if there is an unscripted rise in price inflation. Most everyone doubts that's possible. Certainly the existence of more than $10 trillion worth of securities worldwide priced to yield less than nothing, that's testament to a general conviction that price inflation is dead and decomposing. But, if you look at the rate of growth in various aggregates of the money supply over the past year, you're looking at 15, 20% year over year and higher. Never higher rates of broad money growth in peacetime than at the present moment. The Fed's balance sheet is shown 80% or so year over year growth. If you annualize that, it's now 700%. The Atlanta, one of the Federal Reserve banks, I guess Cleveland, came out and said that come the next trial by fire, we might be looking at at idealized negative federal funds rate of 14%. That's the analysts' conjecture on what would be the appropriate federal funds rate. So the Federal Reserve and the central banks generally have taken it upon themselves to intervene in a way that is just, to me, astounding. And what is equally marked is how well this has gone over with professional Wall Street. People, you wait, and I wait and hear someone say, isn't this the road to financial serfdom? The Fed's now talking about yield curve control. It's the handsiest federal regulatory agency I can think of. But we all collectively on Wall Street, we kind of take this in stride and say, yeah, that's the Fed doing what it can do and must do, and it's a humane organization. It wants to do well. But these interventions, these policies, radical policy begets more radical policy, which begets more leverage, more frailty, a greater propensity to intervene the next time, and right back in the soup. So whatever question you asked 5 minutes ago, Joe, that's the answer to it.